Hey traders, haven't done a video in quite some time, and I'm starting to get emails of guys are like, when are you doing your next video? So I do them when I have time. I'm sorry I can't commit to a schedule, but like I said, whenever I have time, I do it. Very busy throughout the day. But what I'm going to talk about today is, can you trade through the volatility that we have seen in the last few days due to the coronavirus? So, in the last week, we saw insane volatility, and we haven't seen it in a long time. We had a day, I think, that the VIX, that represents, it's a volatility index based on the options on the S&P, doubled. For those who are following that, this is not very typical to double just in one day. We've seen spikes where it goes up 50% a day, but it actually doubled, and that is scary. It's a representation of risk and fear, and mostly fear. So you should look at that indicator, and it should give you a gauge as to the volatility in the market itself, or what we can expect from the market. So we had the Fed dropping 50 basis points with the surprise announcements. You saw the spikes in the charts. I think it was anywhere from 80 to 100 points on the E-mini S&P during the announcement in terms of range, if I believe correctly. Afterwards it trended down, and afterwards it trended up. So the question is, can you survive through days like this? Can you survive through this kind of volatility? Can you survive through 1,000 points a day on the Dow, where it drops one day 1,000, next day it gains 1,000? So let's go back to a video that I did, I think, a few weeks ago, and it's about risk. And it's actually what I said about risk. Remember that risks in the market and volatility in the market comes when the component was not available, of risk was not available before. So nobody knew what would be the implications of Corona, and all of a sudden everybody panics because the world is starting to shut down. The market is devastated. The algos that are driving the markets are also a little bit, I know it's lack of a better word, they went a little bit crazy. So we saw this volatility. So the question is, can a trader survive through this kind of volatility? I would say it is extremely difficult, because there's a lot of randomness that occurs with very high volatility. So remember, there's a volatility that you can measure, right? Which is, I shouldn't say use the word normal, but I would say something which is normal for traders. So it's a relative word, right? Relative, futures traders, a certain range that you can basically trade within. But when you have days like this, you got to be enormously capitalized in order to survive this kind of volatility. I truly believe that there's some sort of higher level of randomness that's associated with higher level of volatility when you don't see it before. So it's okay not to trade through that. Really, it's okay to stay outside of the game during times where you see volatility that you have not seen before. Now, a lot of traders will jump in and will try to capitalize on it. But what happens most of the time is that there are huge gaps. And I look at the charts. I mean, there are V-shaped reversals or reversed V reversals. So it goes up and all of a sudden it goes down, or it goes down and all of a sudden it spikes. Very hard to guess direction based on that. And I would assume if you're not highly capitalized, you will get stopped out a lot, because what needs to happen is that your stop losses need to be much higher. Now, just as a disclaimer, when you put a stop loss, it doesn't necessarily mean that your stops would get necessarily triggered at that price. It can gap up during volatility, or you just cannot execute a stop loss during such times, because, as you know, the contracts have a certain level of range, and if it breaks that range, then some stops might not get triggered. So you have to be really, really careful with that. So again, the question becomes for every single trader is, what kind of volatility can I survive? What kind of volatility I should trade through? So when you have markets, when you choose markets, right, you choose markets based on volatility. So some traders debate, well, should I trade the mini S&P or the micro NQ or the 10-year notes or gold or crude? And I believe most of them decide the choice of instrument based on the movement in that instrument, whether it's a harmonic, some sort of a pattern type, comfortable at the time. But once in a while, every single commodity will go through volatility, which is just absolutely not typical to its behavior. And again, it comes from what you have to watch out for. I should complete the last sentence. It comes from a place where the market does not know how to assess that risk. So a lot of traders ask, well, do I need to be fundamentally driven or price driven? I don't think there's anybody out there, an intelligent price driven trader, that does not know about external news out there, such as the coronavirus. When something like that happens, you're surrounded with it 24/7. So it's okay to take that kind of element into consideration. If there is anything outside of any outside variable that you think will affect the market, prepare to downsize your position or get out of the market. The interesting thing about the coronavirus is that the coronavirus hit and the market still kept on going higher. It didn't see it as a threat. The coronavirus was not a threat yet to the market until people started realizing, hold on, the world is shutting down. There's less flights. A lot of conventions are being closed. Actually, yesterday we have, it's called, we have a Futures Trading Association convention that takes place in Boca every year, and yesterday it was canceled, or the day before yesterday, I don't recall. It was just absolutely canceled. This is basically all the clearing firms, everybody else. They do it here in Boca every year, and this year it was canceled. So imagine that. A lot less handshakes around the world, a lot less deals, a lot less business transactions. So the market obviously reacts in according to that. But again, pay attention to the fact that it does not affect it immediately. If, let's say, you trade crude oil, okay, and there is a factor outside that is looming out there that you think is big and you think it will affect the market, just looking at that day and seeing does it affect it or not is a mistake, because it could affect it a day after or a week after. Markets do not always digest news right away because, again, this is something that they're not familiar with. The coronavirus was not something that the market anticipated. We had other viruses before, but I don't think we were shutting down the world and flights and conventions and seminars and webinars and everything else as a result of that, right? It just, and also the gathering of large groups. I've heard that in some countries, even the banks, they don't want to have more than 5 people in a room. But anyway, that's a totally different story. What I'm here to tell you is that, if you think something outside is a threat, or I should say a factor, not a threat, but a factor that could affect the market that you're trading, watch out, okay, when it starts affecting it. Adjust the size even before that, and if it doesn't affect it, well, you know what, it's fine. I don't call it panic, I just call it being ready as a trader. So, to summarize, you have healthy volatility, and again, when I mean healthy volatility, it's all in relative terms. I don't want to downplay the risk that exists in futures trading. It's extremely risky, and it's not for everyone. But there is still, I feel, a volatility that those traders that are comfortable with the risk can navigate through. And then there is volatility that it's very, very hard to navigate through. When I think about navigation, I think maybe of something like a ship in the ocean. There is a certain level of wave that even though it's there's a storm, some ships can go through that, and then there are others that are just absolutely impossible to navigate. So as a trader, you have to decide what do you want to trade through. If you're not in the market during those volatile times, I don't want to make you feel that you're missing out. You're not missing out. It's really getting to know yourself as a trader, is getting to know your comfort level and saying to yourself, you know what, I don't want to trade through this. You're not missing out anything. If you're going purely out of greed into the market, into an environment that you're not comfortable with in terms of volatility, then you will lose your funds. I'm not saying that if the market is normal, you're always going to make money. As I said, markets are very difficult and challenging at all times. And you should always use your risk capital consistently. Always risk capital. But at the same time, you should really learn as a trader to see what is the water, right? What kind of storm the water is going through, so you can go in and trade according to your risk tolerance. Again, if you were to approach the markets every time just out of greed and say, let me try and guess the bottom here, if the Dow is, for example, down 1,000 points, and you're like, well, it must recover, right? You know how traders sometimes think it has to recover, it can't stay, and then the market falls, another 300 points. Or as we had in the S&P, I don't forget which day, but I think towards 3 o'clock in the afternoon, the market was down maybe 80, 90 points on the S&P. And then within an hour, it fell another 60 points. So anybody who tried to guess the bottom there, it didn't succeed. It is hard to go and short a market when it's down 90. That's what you should do. The market is weak. You should sell into weakness and buy into strength. But as we know, it's very, very difficult. The reason it's difficult, again, human nature stands in our way. So everything that we've gone through in the last week, make it a learning experience. The first thing you have to learn is to see that any threat to the market that you trade, when I mean a threat, any type of news that could be substantial risk, is not factored into the market right away. The market can continue acting as normally, but if your feeling is not good about it, reduce size. The second thing is, when volatility hits, decide, do you have enough capital to withstand this volatility? Do you have enough, does your plan have risk management to withstand this volatility? Is it worth going through this type of volatilities to gain, risk and reward? Is the risk and reward worth it? And the fifth thing you do is that you learn through that, right? You learn how you behaved during that period. Was it worth staying out, or you should have been in, or you could have survived, or it was worth, psychologically just to stay calm during the non-active times, get your plan together, and then re-enter the markets. I hope it helped you. I'd love to earn your business here. If you're a futures trader, go to optimusfutures.com. We have lots of demos over there. And also you can call us here. It's 1-800-771-6748. Email us at support@optimusfutures.com. And we'll look forward to hearing from you. And I look forward to doing the next video. I don't know when it's going to happen, but if you click the like button, maybe I'll do them more often. Okay? Take care and all the best. Bye.